Welcome to This Explainer. Today we're going to be tearing down some old, outdated money myths and looking at the absolute blueprint for business profit analysis. You see, we're shifting away from just passively tallying up your revenue to actively analyzing your margins, controlling your cash flow, and ultimately maximizing your company's success. Okay, so let's dive right in with a pretty fundamental question. What actually is the real job of business finance? Is it just generating a historical receipt to hand over to your accountant at tax time? Because let's be honest, far too many founders treat their finances exactly like that, like a rearview mirror. It's just a mere record of what already happened. But if you want to scale and, more importantly, survive in today's market, that perspective has to drastically change.
The reality is that finance is active, rigorous money management. It's a comprehensive, strategic system. It's about deeply understanding exactly where your capital originates, planning precisely where it needs to be deployed, controlling those pesky operational leaks, and ensuring bottom-line growth. Think of it like this. It's literally the engine that prevents your business from stalling out when unexpected roadblocks appear.
So, here is our roadmap for today. We'll move quickly from the true meaning of finance into tracking and budgeting, right into deep profit analysis and cash flow mastery, before wrapping the whole thing up with business reserves, investments, and our ultimate growth formula. All right, let's start with the foundation, tracking income and expenses. Step 1 is analyzing your income. Now, in a modern business context, this isn't just one big lump sum magically hitting your bank account every month. Today's businesses have multiple, complex revenue streams. You might be pulling in core service fees or recurring SaaS subscriptions, maybe some affiliate revenue or digital product sales. You must dissect exactly which of these streams brings in the highest margin, not just the most volume. Step 2 requires tracking every single business expense, and I mean every single one, from major fixed costs like your commercial office lease and your payroll, right down to the variable costs like travel and client dinners. And please, do not ignore those digital subscriptions. Unmonitored B2B software subscriptions or forgotten cloud hosting fees, they will quietly eat away at your margins month after month. You absolutely have to maintain control over these operating expenses. Okay, transitioning now into the real core of our financial strategy, budgeting and profit analysis. Step 3 is budget planning. For a business, we have to translate these 4 classic categories into a real corporate strategy. So, needs are your non-negotiable operating expenses, your payroll, your servers. Wants are your discretionary spending, like office perks or maybe some experimental marketing campaigns. Savings form your critical corporate cash runway. And finally, investments represent the capital you're directing into new product development. By segmenting your funds like this, you ensure operations run smoothly while systematically carving out the capital you need to scale. Now, here's where deep profit analysis really comes into play. Imagine you run an e-commerce brand, right? You might see a massive $100,000 spike in revenue and think, wow, we are absolutely crushing it. But hold on. When you factor in your customer acquisition costs on ad platforms, your complex supply chain logistics, and your web hosting, your true expenses might actually be $105,000, meaning you're operating at a loss. Profit analysis isn't about celebrating top-line revenue vanity metrics. It's about rigorously analyzing the margins to ensure sustainable survival. Let's move to our next section and see how this all builds into the critical concept of mastering your cash flow. Step 5 focuses entirely on cash flow. And here's a harsh reality. A business can be wildly profitable on paper and still go completely bankrupt. Why? Because cash flow is entirely about timing. It is knowing exactly when money arrives and when it leaves. Think about it. If a major enterprise client pays you on a 60-day invoice cycle, but your payroll and vendor bills are due every 14 days, you have a dangerous cash flow gap. Mastering timing prevents you from taking on high-interest emergency debt just to keep the lights on. Once the daily tracking, profit analysis, and cash flow timing are handled, we pivot towards savings and investment planning. Step 6 is building your corporate emergency fund. This acts as your business's ultimate financial shield. Markets are unpredictable, folks. As a founder, you might face a sudden personal crisis that pulls you away from operations, or maybe you suddenly lose a massive client contract, or there's a severe, overarching economic slowdown. A healthy cash reserve ensures that when a crisis hits, you don't have to immediately lay off your team or shut your doors. It gives your business the breathing room to pivot and adapt. Step 7 outlines your investment timeline. Once overhead is covered and your corporate safety net is fully funded, your capital cannot just sit there idle, gathering dust. You must transition into strategic reinvestment. The goal here is to grow your money exponentially over the long term. This means deploying those analyzed profits to maybe acquire a competitor, build new proprietary software, or scale into new global markets. You've got to let your capital do the heavy lifting for your future growth. So, the crucial point is how all these steps combine to give you immense control over your business. Let's look at the final growth formula. With deep profit analysis in place, you are completely empowered to make fundamentally better business decisions. Because you track everything, you know exactly where to cut waste. But more importantly, you can identify which specific products or services actually bring in the most profit. For instance, let's say a marketing agency realizes their high-revenue video production arm actually has terrible margins, while their low-cost SEO audits are highly profitable. Armed with that data, you stop guessing, you drop the low-margin vanity work, and you double down on what genuinely drives your success. And this brings us to the final cyclical blueprint. Number 1, plan your capital allocation. Number 2, track your operating expenses down to the last software seat. Number 3, rigorously analyze your profit margins to ensure your business is actually moving forward. And finally, number 4, grow through smart, long-term business reinvestment. I'm going to leave you with this final thought. If you want to optimize your company's financial health, you have to start today. It is the unglamorous daily habits of tracking and analyzing margins that build true